Creating a diversified investment portfolio is a key strategy for managing risk and achieving long-term financial goals. To start, it's essential to define your investment goals. These goals can be short-term, such as saving for a vacation or buying a car; medium-term, like accumulating a down payment for a house; or long-term, including retirement savings or funding your children's education. Next, assess your risk tolerance, which reflects how much risk you're comfortable taking. This varies based on factors like your age, income, investment experience, and specific financial goals. Also, evaluate your risk capacity or your financial ability to take risks, which helps shape your investment strategy. Determining your asset allocation is the third step. This involves deciding how to spread your investments across different asset categories, such as stocks, bonds, real estate, and cash. For example, someone with a high risk tolerance might allocate 70% to stocks, 20% to bonds, and 10% to real estate and cash. In contrast, a conservative investor might prefer 30% stocks, 50% bonds, and 20% real estate and cash. Diversification within asset classes is also crucial. For stocks, diversify by investing in various sectors like technology, healthcare, and finance, and across different geographies and market capitalizations. For bonds, consider different types like government, municipal, and corporate bonds with varying maturities. In real estate, a mix of residential, commercial properties, and real estate investment trusts, REITs, can offer a balanced exposure. Choosing the right investment vehicles is the next step. You can invest in individual stocks and bonds, which require active management, or opt for mutual funds and ETFs that provide diversified exposure with less hands-on management. Index funds, which track specific market indices, offer broad market exposure at a low cost and are an excellent option for many investors. Tax efficiency is another important consideration. Utilizing tax-advantaged accounts like IRAs, 401(k)s, or Roth IRAs can maximize your tax benefits. In taxable accounts, prefer tax-efficient investments like index funds and ETFs due to their lower turnover and tax impact. Regularly reviewing and rebalancing your portfolio ensures it stays aligned with your goals and risk tolerance. This involves periodically assessing your portfolio's performance and making adjustments, such as selling overperforming assets and buying underperforming ones to maintain your desired asset allocation. Staying informed and educated about market trends, economic conditions, and personal financial changes is essential. Continuous learning and consulting with a financial advisor can provide personalized guidance and help you make informed decisions. Automating your investments can ensure consistent investing. Setting up automatic contributions to your investment accounts and practicing dollar-cost averaging, investing a fixed amount regularly regardless of market conditions, can reduce the impact of market volatility. Lastly, monitor your progress regularly. Use tools and apps to track your portfolio's performance against your goals and make necessary adjustments based on significant life changes, like marriage, having children, or a job change. By following these steps, you can build a diversified and balanced investment portfolio tailored to your financial goals and risk tolerance for 2024 and beyond.